Artificial intelligence might be spiraling out of control. AI is officially controlling the stock market in both good ways and bad. In this video, we'll uncover how artificial intelligence recently sent one company almost out of business, gave another company $1 trillion valuation, and how AI caused the stock market to lose $500 billion in a matter of minutes. On May 22nd, shortly after the US markets opened for trading, an alarming image started doing the rounds on Twitter. It showed a large puff of smoke near the Pentagon complex in Washington, D.C., sending citizens and investors into a frenzy. Multiple verified handles on Twitter, including some backed by the Russian government, shared the picture, stating that the Pentagon, headquarters of the U.S. military, had been hit by an explosion. The ominous image of black smoke coming from what appeared to be a government building set off investor fears, sending stocks tumbling. The panic rapidly spread to the markets, and the S&P 500 index skidded to the session's low, shedding $500 billion within minutes. Thankfully, experts quickly dismissed the picture as a fake, revealing that it was created using artificial intelligence, and markets swiftly recovered. But it illustrated one of the big fears behind the government's desire to regulate AI, that the technology could be used to stoke panic and sow disinformation with potentially disastrous consequences. In addition, the incident underscores how even unsophisticated spoofs can spread misinformation quickly, especially via trusted social media channels. Regulators have warned about exactly this kind of problem. SEC Chairman Gary Gensler recently said that bad actors could use AI to exploit the fragility of financial systems. Didn't take long for that to happen. The FTC has also raised the alarm about how AI-generated deepfake images and cloned voice systems could be used to trick people in new kinds of fraud schemes, and more potent threats may be coming. Our last video on the dangers of AI detailed OpenAI CEO Sam Altman's stunning testimony before the Senate that frightened lawmakers in Washington. In a recent blog post, Sam Altman and two top lieutenants warned that within a decade these systems could achieve superintelligence. In response, they said global governments should consider creating a regulator akin to the International Atomic Energy Agency that can inspect, audit, and when necessary, restrict systems that go beyond a certain level of capacity. Governance of the most powerful systems, as well as decisions regarding their deployment, must have strong public oversight, said Altman. It's worth noting that AI isn't always terrible for stocks. In fact, it's largely been to the benefit of a handful of companies. As of last month, just 7 stocks have accounted for 85% of gains in the S&P 500 this year. All but one member of that group is invested heavily in AI. Investors have driven up the market caps of companies tied to the technology, including Alphabet, Meta, Microsoft, and the chip maker nvidia. Shares of nvidia soared about 28% after reporting that their Q1 earnings results were well above what the market had forecasted. Driven by an ongoing global transition toward accelerated computing and power-generative AI, NVIDIA beat Wall Street's revenue estimates by a whopping $669 million. Thanks to AI, NVIDIA stock reached an all-time high and now has $1 trillion market cap, making it now the 6th most valuable company in the world, just behind Amazon and in front of giants like Tesla and Meta. NVIDIA's stock price has already doubled this year and tripled since just October. And in just 2 days, NVIDIA's market cap swelled by over $180 billion, which is more than the total market cap of AMD, its closest competitor. If you've been tuned into our channel and watched our previous videos on AI stocks, NVIDIA's success doesn't come as a surprise to you at all. Months ago, we listed NVIDIA as one of the top AI stocks to invest in now. We are experiencing a paradigm-altering wave of artificial intelligence. Some compare it to the gold rush of 1849, except this time it's built around generative AI and large language models. It's estimated that 95% of chips used in the AI space are made by NVIDIA, making them essentially the only game in town. It's undeniable that NVIDIA is powering the AI arms race, and if we were to compare the AI wave to the California gold rush, NVIDIA would be the company selling the shovels. They continue to make massive breakthroughs in AI using neural physics. They have the most powerful GPUs on the market, and analysts suggest that their ability to generate revenue on cutting-edge technology is 2 or 3 years ahead of the competition. Companies that aren't embracing artificial intelligence and finding a way to utilize it to increase revenues had better find a way to do so, and fast. Chegg, the education technology company, tanked nearly 50% after revealing that its customers are using ChatGPT instead of paying for its study tools. Chegg provided homework assistance, digital and physical textbooks, online tutoring, and other services to millions of students. Unfortunately, the edtech company announced that ChatGPT is killing its business. Chegg CFO Andy Brown believes that the popular chatbot has taken around 100,000 would-be subscribers from its company. This is most meaningful considering that subscription services account for 90% of Chegg's overall sales. CEO Dan Rosenwig says that he met with Sam Altman to create a partnership called CheggMate, an AI learning companion powered by GPT-4. Chegg's own algorithms and its repository of 100 million study questions built over previous years. He hoped that this partnership would undo ChatGPT's damage to Chegg's subscriber growth. Just weeks later, however, Rosenwig revealed the stunned growth to investors and said Chegg would not provide revenue forecasts for the second half of this year because the relationship students would have with ChatGPT when they return to school after the summer break was anyone's guess. Investors were surprised at Chegg's announcement, and as a result, the stock plummeted, causing the company to lose half of its market value overnight. In 2020, Rosenwig was warned by a former product leader that generative AI would be the bus that ran down Chegg if it didn't prepare itself. It seems that the prophecy has come true. Last year, Chegg didn't mention artificial intelligence a single time in its annual report to investors. This year, it came up 9 times, mostly as a threat. Chegg isn't the only company in crisis. ChatGPT has induced euphoria for companies like Microsoft and nvidia. On the other hand, concerns have mounted for businesses such as Chegg, Duolingo, and Udemy as investors consider them to be threatened by ChatGPT's ability to play teacher and tutor. Truthfully, many more stocks are vulnerable to AI-driven disruption. Time is running out and companies need to adapt quickly or AI will run their business into the ground. At the end of the day, some companies are thriving because of it, and others are reeling. Either way, artificial intelligence is already firmly controlling the stock market. If you enjoyed this video, please drop a like and comment which companies you think will boom or bust in this new AI environment. Don't forget to subscribe for more content like this, and we'll see you next time.